Speaking with us today is Laura Champine of Cowen Co. She's a Bloomberg Best, one of the top-ranked analysts covering the retail sector. Laura, welcome to InBusiness.
Thank you.
So does getting healthier on paper translate to spending that money in stores?
It's not clear. I mean, we are in a recovery. The consumer is recovering, but I think that it's spotty. We're seeing much more strength at the high end than the low end. I would expect growth in most retailers' reports tomorrow, but it won't be booming growth.
Well, consumer discretionary stocks are down today. There's a lot of apprehension about whether consumers, even if they're feeling better, are going to be spending at all. When you say there's a divide, what income level sort of separates who spends and who saves right now?
So I follow a really broad spectrum of companies. Stocks like Family Dollar, the stock's actually held in nicely, but they've been missing sales estimates. Their customer makes $30,000 and below, so that customer base is really hurt by higher food and gas prices.
Even lower end than Walmart.
It is lower end than Walmart. I think the middle income consumer is under pressure. That's why we like the trade down stocks like Ross, TJ Maxx, a middle income consumer trading down. But really strong demand is being seen across the board in luxury stocks.
And those luxury stocks, so often, at least when people talk about Saks and Tiffany's and others, say that that reflects what the stock market's doing, which has been moving up.
Right. And I think that customer base feels a little more steady about their job. They feel like they can count on their income. We may not be seeing wage growth at any level among consumers, but I think that we're seeing strong spending, and some of that is just relief spending.
So when you try to invest in the retail space, is it as simple as looking at the average income level of their customer base? I mean, extrapolating from what you said, Family Dollar's a worry. Does that make me more worried about Walmart, but make me like a Nordstrom better?
If you're looking to invest in growth stocks, I would look at the income strata. Also, I think a big issue that faces consumers this fall will be inflation in soft lines. So I'd stay away from clothing stores.
Well, I'm glad you mentioned that, because I want to play a soundbite here. We spoke to the CEO, Manny Chirico, of PVH. They make Tommy Hilfiger, Calvin Klein, Izod, high and low end apparel. And he told us they're about to raise prices. Listen in.
Of goods are going to be up 13 to 15%. We're trying to be tactical about it, be cautious about putting more into the product, but we will be raising retail prices somewhere in the 7 to 10% range in the holiday season, I believe, along with the rest of the market.
So the cost of making goods up double digits for that producer, the cost of the consumer going up at least 7% by Christmas. Is this in line with what you can expect at most apparel retailers?
Once again, it's going to vary according to what the price point is. Cotton and labor are much a higher percentage of cost for a low-income consumer, for a low-cost product. So, those $5 T-shirts may go up much more than the high-end bags. Lululemon, for example, sells a $100 yoga pant.
Right.
There are lots of places to hide incremental costs in a $100 yoga pant, not so much in a $5 T-shirt from Old Navy. So once again, this is going to pinch the low-income consumer much more than the high-income consumer.
Really a tale of two economies for the consumer right now. Thank you so much, Laura.